Good morning. I'm Shinde. I'm from TYBMS Finance. My roll number is M23167. And my topic for today is limitations of two most important financial risk measurement tools that are beta and introduction, standard deviation. So these measures, which we named beta and standard deviation, are widely used in investment analysis, portfolio construction, etc. While they provide useful insights into the market behavior and volatility, they are not perfect per se. Financial markets are dynamic, influenced with multiple factors beyond systematic risks. So, understanding these limitations is very integral part of knowing uh, and having a risk-taking capability and conditions. So let's discuss them into a little more in depth. So let's begin with beta first. Beta measures how sensitive a stock is relative to overall market movement. A beta greater than 1 means that the stock is more volatile than the market, while beta below 1 shows that it is less volatile than market. It plays a central role in the capital asset pricing model, that is CAPM, which we have used profoundly, which was developed by William Sharpe. So, which links risks and expected returns. Investors use beta to evaluate systematic risk. That means all the risk related to the market. For example, that could be any type of inflation, any type of depreciation, etc. But there are some certain limitations to this beta calculation. So let's discuss it in the next slide. So what are the limitations of beta? So beta has several limitations. For us to list some, first it is based directly and single-handedly on historical data dependent. So what does historical data mean? That all the calculation of beta of the all the risk assessment is done with the prior knowledge. So rather than predicting the future, it is using the history as the core values of making predictions. So that is one of the key limitation. Beta values also change depending on the time period of the benchmark used. So there are multiple benchmarks which could be used. So that it hugely or highly differentiates the what do you say, the stability that a beta can give. So another key issue is that beta ignores company-specific risks, assuming diversification removes it, which is not at all practical. Beta also assumes that linear relationships between stock and market returns, which breaks down the during extreme events. So, for example, a very recent example of this is COVID. So multiple investors, lakhs and millions of investors who had made assumptions on based of beta could not have humanly calculated any sort of epidemic as COVID. So that was a big learning lesson, and it is a prime example of limitation of beta. So let's talk about standard deviation. So what is standard deviation? So this measure captures total volatility by showing how much return fluctuate around their average. So it is a core concept which was developed by Harry Markowitz. Higher standard deviation indicates greater uncertainty or volatility in returns. Investors often use it to compare the riskiness of different assets. However, volatility alone does not always equal risk, especially from an investor's perspective. Like, for example, one of the key thing to note about standard deviation is that um, having a high standard deviation does not mean that it is riskier, or does not mean that it is a bad thing for the investor. High standard deviation means high volatility. It could be high risk, it could be high losses, it could be high profit, it could be high volatility, any of the above. So it is one of those measurement tools which are profoundly used. So again, there are various limitations to these as well. So let's talk about standard deviations limitations. So standard deviation treats all the volatility equally. So whether the returns are above the average or below the average, it is equal for it. It just measures the difference between the starting point and the ending point without knowing what is positive, what is negative. But investors usually worry about more about losses than gains. So many times having a high standard deviation shies away the investors, and that actually affects the investment market a lot. It also assumes that return follow a normal distribution, which is rarely true in real market where the extreme events occur more often. So any sort of economic losses, economic slowdown, recession, all these things are very difficult to predict because of standard deviation. Additionally, standard deviation is sensitive to outliers and depends on past data. So similar to beta, it again relies a lot on historical data. So rather than predicting the future, they're looking back at the history. Uh, and for all the outliers, it is a uh, very bad thing to happen. So it also ignores the liquidity risk and investor preferences. So while it measures variability effectively, it does not capture the true nature of the investment risk. So as I said, that it measures from zero to the final point without knowing what is positive, what is negative, whether it's moving up or moving down. So it does not actually show the riskiness; it only shows the volatility. So from investor's point of view, it is not a risk assessment measure or an accurate risk assessment measure. So let's talk about the real world implications. To conclude, beta and standard deviations remain essential tools. They are very essential to us in the financial analyst market, but they should not be viewed as the complete truth because they are far from it. Even they are just the calculation of the systematic risk in the market, not about the unsystematic risk. And the risk of unsystematic ways or factors is way higher than the systematic risk, which is not at all calculated. They both rely heavily on the historical patterns and specified assumptions that may not hold in changing markets. Effective risk assessment requires combining these metrics with broader analysis, judgment, and forward-looking tools. So this means that uh, even having a historical data or having some sort of pattern into it, the investor has to use their own mind, their own ways of intuition, own judgment to make a final decision. They cannot just put their values or put their numbers into a system or a formula and just get a correct answer every single time. Every investor who understands the limitations are better equipped to make balanced decisions. Ultimately, the risk is multidimensional and no single number can fully capture the complexity of the financial uncertainty. As again, discussion all the prior slides, it is very difficult for anyone, almost quite impossible to calculate risk just on the basis of numbers. So there are various factors which go into risk assessment and the actual risk of the of the investment of the portfolio. So it is again, it can help, it can aid the investor, but it is not at all a final decision maker. So that was it. That was all about the limitations of beta and standard deviation. Thank you so much.